Well, here we go again. It feels like almost an annual tradition now, doesn't it? This high-stakes political theater in D.C.
Yeah, the potential for another US government shutdown, what is this, the 22nd time since 1976? Something like that?
Exactly. Lots of noise, lots of chaos, you'd think. But then you look over at Wall Street, and it's bizarrely calm. Actually, better than calm.
Right. It's kind of wild. The Dow just hit a record high. S&P 500 up, too.
And even crypto, Bitcoin specifically, it's just holding steady above, what, $70,000 in September, which is usually a terrible month for it.
Holding strong. So yeah, traditional finance seems completely unbothered by the Washington drama, like background noise.
Okay, so that's what we're diving into today. We've got a stack of sources to help us figure out, why the markets are shrugging this off.
And what the actual cost of a shutdown is, economically speaking.
Yes, and maybe more importantly for our listeners, what's happening under the surface in the crypto world. Because while DC argues there are some, monumental regulatory shifts quietly taking shape.
Absolutely. Big stuff happening with the SEC, CFTC, tokenization.
So let's start with the shutdown itself.
Yeah.
What's the core disagreement this time around?
Well, it's the classic budget fight, really. It boils down to policy writers on the funding bill, the continuing resolution, or CR.
Okay.
Democrats want certain policy changes baked in, like reversing Medicare cuts, other things too. Republicans are pushing for a clean CR, just funding, no extra policy stuff attached.
And if they don't agree by midnight, shut
down. Non-essential government operations just stop.
And like you said, we've seen this play before. Many times. The longest was, 35 days back in 2018, 2019, over the border wall funding.
That's the one. And the immediate impact, it's really on the federal workforce. You're talking 3.4 million people affected.
Right. About 900,000 of those are deemed non-essential and get furloughed.
Furloughed, yeah. So no work, no immediate paycheck. Now, legally, they do get back pay once the government reopens, eventually.
But eventually doesn't pay the mortgage next week. Creates huge stress.
Exactly. And that last big shutdown, the back pay alone, cost taxpayers like $5 to $10 billion for work that didn't even happen during the closure.
That's just incredible waste. And then there's the other group, the essential workers.
Yeah, about 2.5 million of them. Think military, TSA, air traffic control, border patrol. They have to work.
But without pay. Until it's resolved.
Without pay, you can imagine the morale hit. We saw people calling out sick in 2018-19, remember?
Yeah.
Just the perceived unfairness of it all.
Yeah, I remember that. But this time, there seems to be a potentially sharper edge to the threats.
That's a crucial point from the sources, yeah. There's talk, at least from one faction, of using this not just for temporary furloughs, but for actual mass firings of federal employees.
Whoa. Okay, that changes the game entirely, doesn't it? Historically, markets ignore shutdowns because they're temporary.
Yeah.
Mass firings. That's structural. That's different.
Completely different. That would likely spook the markets in a way previous shutdowns haven't. But setting that potential escalation aside for a moment, the standard economic impact is still significant. Economists estimate each week of a shutdown shaves about 0.1 to 0.2 percentage points off GDP growth.
Measurable damage. And then there's the data problem.
Yes, the data delay. This is kind of insidious for finance. Key agencies like the Bureau of Labor Statistics, they shut down too.
So no monthly jobs report, no unemployment stats.
Potentially delayed, yeah. Which makes the Federal Reserve's job much harder. How do you set interest rate policy accurately if you don't have the latest economic picture? It adds fog.
Right. Okay. So given all the worker impact, the GDP hit, the data fog, the potential for firings, why are markets hitting records? Why the disconnect?
Historically, it comes down to one core belief. The U.S. government will still pay its debts. Shutdowns are seen as political theater, internal squabbles. They don't signal a risk of the U.S. defaulting on its bonds.
And default risk is the real panic button for global markets.
That's the one. As long as Treasury payments keep flowing, investors tend to see shutdowns as, temporary friction that'll get resolved. Annoying, maybe costly, but not systemically threatening.
And the historical data seems to back that view up, doesn't it? Looking at the S&P 500 since 76.
Yeah, the average return during a shutdown period is basically flat, 0%. 50-50 chance of being up or down. No clear trend.
But the market looks ahead.
Always. 3 months after the government reopens, the average S&P return jumps to positive 2.6%.
Okay.
And go out 1 year after reopening since 1980, anyway, the average return is almost 17%. So investors anticipate that rebound. They buy through the noise.
And part of that rebound must be that delayed spending, right? That back pay eventually gets paid out, people spend it.
Precisely. That $5 or $10 billion isn't destroyed, it's just delayed. It often leads to a little bump in consumer spending right after reopening, helping the immediate recovery figures.
So predictable volatility, followed by a likely rebound. Market sees it as a pattern.
A known pattern, yeah. Unlike, say, the crypto markets, which are still figuring out their own cycles.
Right, let's pivot to that. Bitcoin holding above $70, as we said, and it's defying the usual September slump. What's going on there? It's up over 5% this month so far.
Yeah, September is historically Bitcoin's worst month, but this could be the third positive September in a row if it holds, which feeds into the whole debate about market cycles. Are the old rules still applying?
Okay, lay out the main theories the sources are talking about.
Well, theory one is just the classic four-year cycle. You get the big run-up, the peak, and then bam, a brutal crypto winter, an 80% or more crash, and a long recovery. We've seen it before.
The tried and true, if painful, pattern.
Right. Then theory two is the extended cycle. The argument here is that this cycle is different, it's longer, because the Fed hasn't really started easing monetary policy yet.
They're still doing quantitative tightening, selling bonds, right? And only one tiny rate cut so far.
Exactly. So proponents say real easing is still ahead, and that could push the growth phase out much longer than usual, keep the party going.
Interesting. And the third one, the super cycle.
The super cycle theory. This one argues Bitcoin has basically grown up, with ETFs, institutions buying in, companies holding it on their balance sheets, the regulatory picture getting clearer.
So the idea is that future corrections will happen, driven by market forces, but we won't see those devastating multi-year 80% drawdowns anymore. No more crypto winters.
That's the core idea, yeah. It's reached a level of maturity and integration that dampens the extremes.
But I wonder, is that premature? I mean, maturation means acceptance, yes, but Bitcoin's volatility is still way higher than traditional assets. Couldn't an 80% drop still technically happen, even with ETFs?
That is absolutely the counterargument. Institutional rails might provide more stability, but do institutions handle massive speculative swings better than retail did? We don't know yet. The supercycle assumes they do, or that their presence prevents those extremes in the first place. We're kind of in uncharted territory.
Yeah, we are. Okay, while that cycle debate happens, let's talk about those regulatory shifts you mentioned, because this seems like genuinely groundbreaking stuff happening while everyone's distracted by the shutdown.
It really is. SEC Chair Paul Axons actually called the new level of cooperation between the SEC and the CFTC a watershed moment for U.S. financial markets.
And you really have to stress how big that is. These two agencies used to clash constantly, right? SEC saw tokens as securities, CFTC saw them as commodities. Lots of turf wars.
Total turf wars. Them working together now signals a much more coherent and organized approach from the U.S. regulators. It's less about fighting over who's in charge and more about building a functional framework.
What are they working on together?
One big thing is tokenized stocks. The SEC is actively drafting rules to allow stocks represented as tokens to trade on blockchains.
Which could mean 24/7 trading. More global access, lower costs.
Potentially all of the above, huge implications for market structure if it comes to fruition.
Wow. And what about crypto ETFs? We have Bitcoin ETFs, Ether ETFs are alive. Solana seems next.
Looks very likely. Analysts like Eric Balchunas put the odds of a spot Solana ETF approval in the U.S. near 100%. The main thing left is the S1 filing approval.
Okay, let's clarify those filings for people. There's the 19B4 and the S1. They're different steps.
Totally different. The 19B4 is basically the stock exchange asking the SEC for permission to list this type of product. It's the rule change approval. The SEC says, okay, this structure is permissible under our rules. That's done for Solana.
Got it.
The S1 is the specific funds registration statement. It's like the detailed business plan, how the fund works, the risks, the fees, how it will track Solana's price accurately. That S1 needs SEC approval before that specific ETF can launch. It's the final green light.
Right, okay, that makes sense. And diving deeper into regulatory philosophy, there was that recent clarification about DPIN tokens.
Yeah, decentralized physical infrastructure networks, like Do0's H2G token was mentioned. The SEC clarified these are not securities.
And the reasoning is key, right?
Absolutely key. It goes back to the Howey test, the standard for determining if something's an investment contract, a security.
Right. Expectation of profit based on the efforts of others.
Exactly. But with DPNs, the token's value, or the reward you get in tokens, comes from your own work. You're providing actual physical resources, storage space, computing power, network bandwidth. You're running infrastructure.
So it's payment for doing work, not profit from someone else managing an enterprise for you.
Precisely. It's a reward for participation and contribution, not passive investment returns based on a central management team. That's a huge clarification. It suggests the SEC isn't looking to stifle the development of these foundational Web3 networks.
That's genuinely significant. Okay, so the U.S. regulatory picture is clearing up. What about adoption? Globally, institutionally?
It's accelerating, even at the U.S. state level, which is fascinating. We saw conservative states like Texas, Utah, Wyoming looking into holding Bitcoin reserves. Now Massachusetts, a Democratic state, is moving forward a bill, S. 1967, to allow the state to hold Bitcoin in its reserve fund.
Wow, that's real bipartisan movement. That feels like a major step for normalization in the U.S.
It is, and corporates are still accumulating. Tether's treasury keeps growing over 86,000 Bitcoin now, plus gold, even equity in a South American agricultural company.
Diversifying beyond just digital assets.
And it's not just Tether or U.S. firms. A French company, Millennium Capital, is raising 50 million euros specifically for a private corporate Bitcoin treasury model. So European companies are getting serious too.
And the banks. Are they getting involved beyond just offering crypto trading?
Yes, in the plumbing. Visa is piloting Visa Direct, using stablecoins for cross-border payments. This is really interesting.
How does that work? Why use stablecoins?
It's about capital efficiency. Right now, if banks or remittance companies send money internationally, they often have to park large amounts of actual fiat currency in escrow-like accounts, sometimes called ASRO accounts, for days, just waiting for settlements to clear. It ties up huge amounts of capital.
Okay, I see. Locked up cash.
Exactly. With stablecoins, they can pre-fund accounts almost instantly for settlement. The capital is only locked up for moments, not days. It dramatically frees up liquidity for these companies. It's using crypto to solve a very real, very expensive traditional finance problem.
That's a powerful use case, solving actual friction.
And then there's the broader infrastructure for tokenizing other assets. Kronos, which is backed by Crypto.com, is partnering with Amazon Web Services, AWS.
AWS, okay. That's serious infrastructure.
Right. They're building tools to help businesses tokenize real-world assets, think real estate, private equity, maybe even things like gold securely and compliantly on the blockchain. They're aiming for $10 billion worth of tokenized assets by 2026. That AWS partnership gives it enterprise-level credibility.
So the rails are seriously being built now. Regulatory clarity is emerging, banks are integrating, states are buying, corporations are holding, infrastructure for tokenizing, everything else is scaling up.
It feels like a different phase entirely compared to even a couple of years ago.
Which brings us to a really interesting final point from the sources. This contrast between pure intelligence and actual investment psychology.
Ah, the Newton story.
Well, first, the modern parallel. There's this anecdote about John Hun Kim, supposedly has an IQ of 276, incredibly high, who apparently went all in on Bitcoin, believing it's, quote, the future's only hope.
Peak conviction from peak intelligence, maybe.
Maybe. But then you contrast that with Sir Isaac Newton, undeniably one of the greatest scientific minds ever. Calculus, gravity, optics.
A certified genius.
And he got absolutely wiped out in the South Sea Bubble in 1720. Lost a fortune, something like £3 million in today's money.
And the story goes he actually made money initially, sold, got out.
Yes, he got out. But then he saw his friends getting richer, the hype kept building, FOMO kicked in, fear of missing out.
He bought back in right near the top.
Yeah.
And then it crashed.
Leading to his famous quote, I can calculate the motion of heavenly bodies, but not the madness of men. Even Newton couldn't resist the emotional pull of the market mania.
It's such a powerful lesson. High IQ is no defense against market psychology.
So let's try and tie this all together. We've seen the traditional markets largely ignoring the DC shutdown drama, focusing instead on the historical pattern of temporary disruption followed by recovery, as long as default isn't on the table.
Well, underneath that political noise, the actual plumbing and regulatory framework for crypto and digital assets is undergoing a massive, arguably historic, build-out and clarification. SEC, CFTC cooperating, tokenization moving forward, banks solving real problems with stablecoins.
States and institutions normalizing Bitcoin. It feels like the system is finally truly opening the gates. Legitimacy is being conferred by the most sophisticated players.
Yeah, the institutional acceptance phase seems well underway.
Okay, so here's the final thought for you, the listener, to chew on. We see the smartest regulatory bodies, The biggest financial institutions finally embracing this space, building the compliant rails, making it easier than ever to get involved. But if Isaac Newton, one of history's supreme intellects, proved that raw intelligence is useless against the emotional roller coaster of market cycles, against FOMO, how should you manage your own psychology in this new era? As Bitcoin and crypto become more mainstream, more accessible, perhaps even feel safer because institutions are involved, does that make navigating the inevitable booms and busts any easier emotionally?
That's the multi-million-dollar question, isn't it? Knowing something intellectually versus living through it emotionally, completely different things, something to really reflect on.